Welcome to the Explainer. So, you've been studying the crypto markets, right? Well, you probably already know there's a massive gap between just throwing money at a screen, hoping something sticks, and actually trading with precision. Today, we're unpacking the ultimate graduation test. We're going to walk through the exact 13-point day 30 final assessment required to become a professional crypto trader. Think of this checklist as your absolute barrier to entry. Which brings us to the ultimate question. Do you actually have what it takes to trade like a pro? Let's dive in and see if you're ready to make that leap from a novice relying on luck to a highly disciplined professional using a strict, totally unemotional checklist. And a quick heads up, every single step we're about to cover from the source material is completely non-negotiable. Here's our roadmap for this professional trade anatomy. Phase 1, choosing your crypto assets. Phase 2, reading the market data. Phase 3, building the trade hypothesis. And Phase 4, execution and final review. Let's get into it. Starting with Phase 1, choosing your crypto assets, also known as the macro view. Look, before you even think about chasing that shiny new obscure token, this assessment demands a strict top-down approach. Step 1, you analyze Bitcoin. Step 2, you analyze Ethereum. And only then do you move to Step 3, analyzing one specific altcoin. Why? Well, because Bitcoin and Ethereum are the undisputed heavyweights, right? They dictate the weather for the entire market. If Bitcoin is caught in a brutal downtrend, that altcoin you want to trade is going to face a severe headwind. You absolutely have to know the macro conditions first. Analyze BTC, analyze ETH, analyze one altcoin. This quote brilliantly illustrates a core philosophy of the professional trader. See, amateurs often get totally tunnel-visioned. They fall in love with one specific altcoin and just ignore the broader market entirely. Huge mistake. A pro always starts by understanding the broader ecosystem's momentum. You got to confirm that the general market direction aligns with, or, at least doesn't completely contradict the isolated move you're trying to make. Moving right along to Section 2, reading the market data. This is the technical breakdown. Okay, so once you've picked your altcoin, you're shifting from that big picture macro weather to the micro science of the charts. Your very next task on the final assessment is to identify the market structure. This basically means defining the overarching trend and the actual behavior of the asset's price movements. Like, is it making higher highs and higher lows, or lower highs and lower lows? Nailing down the market structure dictates the underlying current you'll be trading within. Basically, you need to know if you're swimming with the tide or fighting against it. Right after you establish the market structure, you've got to map out your support and resistance levels. You probably already know these are the historical battlegrounds between buyers and sellers, the key price levels where an asset historically struggles to fall below, which is your support, or break above, your resistance. Defining these zones isn't just some friendly suggestion. It's absolute fundamental table stakes before you can even think about making a move. To wrap up your technical breakdown, the checklist demands two more essential elements. You must analyze volume and you gotta apply your indicators. Volume is essentially the truth serum of the market. It tells you exactly how much weight is actually behind a price movement. A breakout on low volume? Yeah, that's probably a trap. But a breakout on massive volume, that is real conviction. Then you apply your chosen indicators just to confirm what the chart structure and the volume are already screaming at you. All right, Section 3, building the trade hypothesis. This is where we get into the risk management plan. Listen closely because this is where a lot of people mess up. Before entering any trade, the checklist requires you to define your invalidation point. This is the exact specific point on the chart where your trade hypothesis is proven mathematically and structurally wrong. And you can't view this as a failure, okay? It is a strictly calculated eject button. Amateurs will just hold on and pray a losing trade turns around. Professionals, they set an invalidation point and they walk away the very second the market proves their idea was incorrect. So here's how you logically structure your setup. You state your asset, you develop a crystal-clear trade hypothesis based on the data, and you define that invalidation point. Only after doing all of that do you calculate your precise position size. And your position size is entirely dependent on how far your entry is from your invalidation point. You're basically doing the math to ensure that if you do have to hit that eject button, your portfolio barely feels a scratch. You have to have this entire thing mapped out before risking a single cent. No exceptions. Which brings us to our final phase, Section 4, execution and final review. Let's call this the autopsy. The protocol now demands you execute a paper trade. You're taking this meticulously calculated hypothesis with its precise position size and that hard invalidation point and putting it to the ultimate risk-free test. A paper trade simply means you're logging the entry and tracking the data exactly as if real money was on the line, but you're purely testing your system and your discipline without any actual financial exposure. But as the source material makes super clear, the job absolutely does not end at execution. Once that paper trade is closed, whether it hit your profit target or your invalidation, you must complete the final 2 steps of the Day 30 assessment. Step 1, record the result. You need to keep a meticulous journal. Step 2, review the decision. You literally have to conduct a thorough autopsy of your entire decision-making process, from step 1 all the way to step 13. And this is fascinating. Notice how professionals define success versus failure at this stage. Reviewing the discipline of your decision matters infinitely more than just the financial results of the paper trade. Think about it. A good trade is one where you followed the hypothesis and respected your invalidation, even if it lost money. A bad trade is one where you totally ignored the plan and reacted emotionally, even if you accidentally stumbled into a profit. The assessment demands that you build a rigorous process you can repeat thousands of times without blowing up your account. So, your paper trade is in the books. You've mapped the macro weather, defined the microstructure, calculated your risk, and tested your psychology. The Day 30 protocol is completely done, and the math works perfectly on paper. But here is the real question to walk away with. The true final assessment isn't about the numbers on the screen. It's about what happens in your head when real money is actually on the line. When the market is practically begging you to break your own rules, will you have the discipline to hit the eject button?